Today, we are starting something new on this channel, a series called Indian Mutual Fund Deep Dives, where we pick up one fund, open it on value research, and walk through it together, section by section. But here's what I want you to get from this, not just a verdict on this particular fund. I want you to understand the framework, what I look for, what I ignore, and what I consider a red flag. By the time this series is done, you should be able to open any fund on value research and read it yourself. The fund we are starting with today, Nippon India Large Cap Fund. Let's go. Before we dive in, a quick reminder. If you haven't seen my direct versus regular mutual fund video, watch that first. The link is in the description. It's a short watch, but it could save you a lot of money. We are looking at the direct plan. That is always the one you want. Every mutual fund comes in two versions, direct and regular. Same portfolio, same fund manager. The only difference is the expense ratio. First, I look at the age of the fund. The direct plan was launched in January 2013, over 13 years of history. The regular plan goes back even further to 2007, giving this fund nearly 19 years of total track record. I prefer funds with at least 4 to 5 years of history. This one clears that comfortably. After age comes expense ratio. The direct plan expense ratio is 2.75%. For a direct plan, this is high. Is it a deal breaker? Not automatically, but it needs to be justified by stronger performance. Let's compare this fund against four peers on both expense ratio and returns. On cost, Nippon has the highest expense ratio at 2.75%. The other four sits between 0.82 and 1.26%. So the question is, does the performance justify it? Looking at 10, 7, and 5-year returns, Nippon consistently comes out ahead of all four peers. I checked 3, 2, and 1-year returns too, the same pattern holds. So, despite the higher expense, Nippon is still delivering better returns after cost. That's what matters. In this case, the expense ratio is justified. After expense ratio, let's look at the assets under management. The fund manages 51,690 crores, roughly 5.4 billion USD or about 19.8 billion AED. For a large cap fund, a large AUM is not a concern. Large cap stocks are highly liquid, so the fund manager can deploy this capital without difficulty. In a small or mid cap fund, this kind of size would be a red flag, but here it is fine. Next, let's look at portfolio turnover, which for this fund is 27%. Turnover tells you how actively the fund manager is buying and selling holdings. A low turnover like 27% means the manager holds stock for longer periods, a more conviction based buy and hold style. A high turnover means frequent trading, which also means higher transaction costs that eat into your returns. 27% is low for a large cap funds. That's exactly what you want to see. Next, the fund manager. And I don't just look at who it is, I look at how long they have been running this specific fund. This fund is managed by Sailesh Raj Bhan, who has been at the helm since the regular plan launched in 2007, almost 19 years running the same fund. That kind of continuity is rare and it's a big positive. You know exactly what you are getting. A second manager, Bhavik Dev, joined in August 2024. Multi-manager setups usually means a succession plan is in place. The fund house is thinking about continuity. That's reassuring. Now the tab everyone jumps to first, and I deliberately live for after the basics, returns. Year to date is minus 6.96. The market has been under pressure this year. Nothing unusual, nothing alarming. Now look at the 10-year annualized return, 15.72%. At that rate, your money doubles roughly every 4.6 years. 1 crore invested 10 years ago would be approximately 4.3 crore today, despite the market being negative this year. I focus on 3, 5, 7, and 10-year returns, not 1 year. Across those four time periods, this one has returned above 15%. That kind of consistency across multiple time frames tell a much stronger story than one good year. A fund that looks great over 1 year could have simply got lucky in a hot sector. This fund's benchmark is the BSE 100 TRI, the total return index, which includes dividends. Across most years, this fund has beaten that benchmark. That matters because if a fund consistently underperforms its index, you would be better off in a passive index fund at lower cost. And given this fund's higher expense ratio, beating the benchmark isn't optional, it's essential. You can also compare it against the large cap category overall. Where does this fund rank among all large cap funds? That tells you whether you are getting an above average manager or just an average one. And now, my favorite data point, the best and worst period table. At its worst, the fund lost around 36% in a year. At its best, it gained over 87%. Both numbers are real, both happened. If a 36% fall would make you panic, equity investing, not just this fund, may not suit your temperament right now. Know yourself first. Now let's go to portfolio tab. Four things I look at here. First is asset allocation. What percentage is in equity, debt, and cash? For a large cap equity fund, I would expect 90% or more in equity. A significant cash position could mean the manager is cautious or struggling to find good stocks to deploy into. Second, category allocation. Even within equity, funds have flexibility. What's the split between large, mid, and small cap stocks? SEBI rules require a large cap fund to hold at least 80% in the top 100 stocks by market cap. The remaining 20% can go into mid or small cap, which adds to a different risk profile. Concentration. How many stocks the fund has? Lower represents high concentration and higher signifies diversification. We can also check concentration of top 10 or 5 stocks or top 3 sectors. Let's check sector wise holdings. Sector allocation. Which sector is this fund betting on? What are the top 10 stocks and what percentage of the fund do they represent? High concentration in the top 10 means the fund rises and falls heavily on a fewer bets. Sector allocation is also where funds diverge most from each other. An overweight in financial versus technology, for example, can explain a big performance gap between two otherwise similar funds. Now, here's something I want to be clear about. A fund that's right for me may not be right for you. If the Indian cricket team needs one more player, they're not going to pick another fast bowler if they already have five. They will pick whoever fills the gap. Mutual fund selection works exactly the same way. The Nippon fund is a large cap fund. If your portfolio already has a good large cap fund, adding this one doesn't diversify you, it duplicates what you have. You might need a mid cap, a flexi cap, or an international fund instead. Your portfolio is your team. Don't just pick who looks good in isolation, pick what your team actually needs. For those who want to go deeper, the risk tab has a full set of ratios. Each one is explained right there on the page. Three I actually look at. Sharpe ratio, return per unit of risk taken. Higher is better. Did the fund earns it volatility? Beta. How much the fund moves relative to the market. Beta of one means it moves with the market. Above one is more volatile. Below one is more stable. Alpha. Extra return above the benchmark. Positive alpha means the manager is genuinely adding value. But if this feels like too much, here's the simplest approach. Look at the long term returns across 5, 7, and 10 years. Then look at the worst period. If you can live with that number, not just intellectually, but without panic selling, you are ready for equity. So let's summarize Nippon India Large Cap Fund. 13-year-old fund, one consistent manager, Sailesh Raj Bhan, running it since 2007, a 15.72% annualized 10-year return that turned 1 crore into roughly 4.3 crore. Low portfolio turnover, a strong benchmark beating track record, but an expense ratio that is the highest among peers, one that needs to keep earning its place through performance, and a 36% maximum annual loss you need to be mentally prepared for. Is it a good fund? By most measures, yes. Is it right for your portfolio? That depends entirely on what you already hold. In the next video of this series, we pick another fund. Same framework, same sections. The goal is simple. By the end of this series, you won't need anyone to tell you what to invest in. As always, this is for educational purposes only, not financial advice. Please do your own research or speak with a SEBI registered advisor before making any investment decisions. If you found this useful, like, subscribe, and share it with an NRI friend who is thinking about mutual funds. Drop your questions in the comments. I read everyone. See you in the next.